Wall Street will try to shake off big losses today. Fed Chairman Ben Bernanke rocked the market by saying the Fed is likely to slow its buying of Treasury and mortgage bonds. On Wednesday, that news sent stocks plummeting more than 200 points. Michael Santoli is a senior columnist at Yahoo Finance. Michael, good morning.
Good morning.
So tell me the impact of this announcement.
Well, initially, the impact on the markets was a worry that interest rates will shoot higher in a rapid and kind of disorderly way, and that's a scary thing. The markets have become kind of, at least psychologically, dependent on this idea that the Fed is going to reliably be buying these assets every single month in the same amount, and there's been some nervousness about exactly what the implications are when they slow that down. But at root, it's the Fed's assessment that the economy is on firmer footing that is behind this guidance.
Mm-hmm. Do you think they're overestimating the strength of the economy?
It's hard to say. I mean, there is very good evidence that because the housing market has gotten some momentum, the auto sector is doing very well, and we've had steady, if not very strong, gains in jobs. Yes, I mean, I do think there's basis for it, but there was also a perception. The Fed has often kind of overestimated how strong the economy was going to be in the past couple of years. And also there was a sort of a sense that Ben Bernanke, the chairman, had an opening to be much more soothing because inflation remains very low. And he could also have had an out by saying, well, the sequester means the government is not helping the recovery out.
Now, the reason that average consumer should be interested in this is because it could affect interest rates.
And it already is, yes. So the Treasury yields are going higher, which drives mortgage rates higher quite directly. We've already probably seen the lows in mortgage rates for the time being. So, yes, that's the most immediate impact.
The idea behind it, in terms of what Bernanke has said, was that he wanted to use the Fed to reduce unemployment levels.
That's right.
Did it work?
Well, it has worked in the sense that unemployment levels have come down. We can't exactly find causation and say the Fed directly was responsible for X number of jobs created. But certainly the Fed has been compressing interest rates, encouraging businesses to borrow and spend. And so that much of it, yes, has worked.
Does the market assume that Ben Bernanke will not be coming back as Fed chair?
Yeah, I believe at this moment it's pretty much assumed January he's done.
All right. Michael Santoli, good to see you. Thank you.
Very much.